Hi everybody. This is the lecture for actually still for topic 1. I supposed to finish this in this lecture. Last week you have seen half of this subtopic. Okay, remember about this? Last week I have explained that in accounting we have assumptions, principles, and constraint, and these are like I said, like rules that you have to follow when you want to do financial accounting record. When you want to record or do accounting record for a business, you have to follow these assumptions and principles and constraint. So in the previous lecture, I have explained about separate business entity, going concern, monetary unit, and time period. Okay, this time, I will start with historical cost. Okay, remember this. Remember, this is the one of the rules or assumption or principle that you have to follow when you want to do the accounting record for a business. So, historical cost means assets of a business has to be recorded at the purchase price. Okay, remember this. This historical cost assumption or principle says assets of a business has to be recorded at the purchase price, not at the market price or current market value. The example is like this. Let's say you have a business and then you want to do the accounting record. So this business has a building. The business has purchased the building in year 2015. At that time, the price of the building is $300,000. So now, in year 2020, the value of the building now is $400,000. You know that the value of a building or a property will increase over time. So when the business purchased the building, the price is $300,000. Now the price is $400,000. So when you want to do accounting record, you have to record the value of the building at $300,000 because you follow this principle. This principle said when you want to record an asset of a business, you have to record it at the purchase price, not at the current market value or other prices. Why you have to record it at the purchase price? Because when you purchase the building, there is a document showing that the value of the building is 300,000. So you have to record using that value, even though the current value or the market value of the building or the asset has increased or decreased. Okay, remember that. Okay, the next thing is objectivity. In this lecture note, it says that disclosing objective information in the financial statement. Objective information means information which is true and can be verified by another party. So this is the principle of objectivity said when you do the recording process, you have to record an objective data and information. So objective data and information means that the data or information can be verified by another party. So let's say you have a business. You want to record a sale transaction made by the business today. So you only can record if the data is objective. Objective means it can be verified by another party. So the simple way to say it is like this. In accounting, you can record a data when the data has a source document. That's why if you go to any shop, when you purchase something or you pay something, you will get a receipt. The receipt is a source document. That receipt shows that one thing had happened, something had happened, and that receipt is something that can be verified. Somebody else can check. There is a receipt and there is a value for that transaction. So if you want to do a accounting record, you have to record only data that can be that is objective, or data that can be verified only. If the data cannot be verified, or there is no document to support the data or transaction, then you cannot record. Okay, remember that. Revenue recognition. So this principle says, in a simple way, I will explain it in a simple way. The revenue recognition principle says, in accounting, when you do the accounting record, you record the value of sales or revenue when the transaction happen, not when you receive cash from customer. Always remember that. In accounting, sometimes something like this can happen. You have a business, and then the thing that can happen is a customer orders a product today. They say today is 1st of November. So today is 2nd of November. So a customer come and orders a product, and then you send the product to the customer on the 3rd of November, and then the customer pay the customer makes payment for the product on the 5th of November, for example. So when is the time to record the revenue for your business? Today, 2nd of November, or 3rd of November when you send the product to the customer, or 5th of November when you receive cash from the customer? So the answer is, you have to record the revenue by following this revenue recognition principle. The principle says you record the revenue when the transaction happen. So when is the time the sales transaction happen? In accounting, the sales transaction happen on the 3rd of November. On the 3rd of November, there is the goods that your business sell is changing hand. The goods that your business sell is changing hand from the hand of the seller to the hand of the buyer, because on the 3rd of November you send the product to the customer. The good has changing hand from the seller to the hand of the buyer. So you record the revenue on the 3rd of November, not when you receive order on the 2nd of November, and also not on the 5th of November when you receive the cash. You record the revenue for your business when the transaction happen, or in other words, when goods is changing hand from the hand of the seller to the hand of the buyer. Okay, always remember, you record revenue in accounting, you record the revenue when the transaction happen, not when you receive cash, or not also when you receive order from customer. Same goes to expenses. If you have a business, you will have to pay many expenses. For example, rental expenses, salary expenses, utility expenses. So when is the time to record the expenses? When the transaction happen, not when you pay cash or you give something, but you record the expense when it happen. You will see in the next topic, you will learn about how to record transaction. So at that time, you will know when you record when you do the accounting record, you have to follow these rules and assumptions that we cover in this topic. Okay, the next principle, matching principle. So in this note, it says that matching principle means expenses of a business must be recognized when the revenue related to the said expense is recognized. Oh, so actually it is something like this. Matching principle says when you want to calculate profit for one accounting period, you have to match revenue for that period with expenses of that period. Okay, so how to understand it? So to understand it, it is like this. In accounting, when you want to calculate profit, the basic formula is revenue minus expenses equal to profit. Let's say you want to calculate profit for the month of October 2020. So to calculate profit for the month of October 2020, the basic formula is revenue for the month of October minus expenses for the month of October. So you will get the profit for the month of October. So that is what matching principle says. If you want to calculate profit for one accounting period, you have to match the revenue for that month and the expenses for that month. So if you want to calculate profit for the month of November, so the calculation is revenue for the month of November minus expenses for the month of November. You cannot do something like this. You want to calculate profit for the month of November, but the revenue is revenue from the month of October, or for the month from the month of December, and then the minus expenses. The expenses also coming from the month of October or from the month of December 2020. You cannot do that. If you want to calculate profit for the month of November, you have to match the revenue for that month and also the expenses for that month only. Okay, you will see that. You will see how you have to use this principle when you do when you learn about the recording process in the next topic, next chapter. Okay, so the next principle is full disclosure. This full disclosure principle said something like this. When you prepare the financial statement of a business, you have to show everything. You have to show all the expenses, you have to show all the revenue, you have to show all the assets, you have to show all the liabilities and equity. If you have your own business, you cannot hide information. Let's say one day you have a business, and then when you calculate the profit, when you prepare the income statement, you show all the revenue, but you hide some expenses, so that the income statement shows that your business has high profit. So you cannot do that. In accounting, you have to do full disclosure. You have to show everything. Okay, you cannot hide information. Okay, the next principle is consistency. Okay, the principle of consistency means something like this. In accounting, in several transaction, you have choices. For example, like this. If you have a grocery shop, you have inventories. In accounting, you can use at least 3 methods to record inventories. We call it FIFO, LIFO, and average method to calculate or to record the inventory. So you have 3 choices. If you choose method 1, you have to be consistent. This year you use method 1. Next year you also have to use method 1. The next year also you have to use method 1. You cannot change. This year you use method 1. Next year you choose to use method 2. The next year you choose method 3. You cannot do that. In accounting, you have to be consistent. When you use one method to record your business transaction, you have to consistent. We have in accounting sometimes we have several choices. to do the recording, to record the transaction. Accounting for inventories, like I told you, have at least 3 choices. And then later you will learn about depreciation. Depreciation also has several methods that you can use. Straight line method, reducing balance method, unit of production method. For so you have choices. When you do recording process for a business, accounting record for a business, when you choose one method, you have to be consistent. Conservatism. Okay, very easy to understand. When you do the recording process, when you record accounting, when you do accounting record for a business, you have to be conservative. You must not overstate profits or asset. You have to show it as it is. Okay. Materiality. So in accounting, materiality means in accounting, when you do accounting record, you have to focus on information which will affect one's ability in making decision. So in other words, it's something like this. In accounting, if an item or transaction is huge in number, or big in number, or big in value, and the transaction is important in nature, then you have to record it according to the accounting standard, or according to the accounting textbook. Okay, very important. But if a transaction or item is very small, and the transaction is not important, then you can group these transactions together and create an aggregate account. So later I will explain in detail. But at this moment, at this point, you have to understand that in accounting, when the transaction is huge in value or number, and the transaction is important, you have to record it like you're supposed to do it according to accounting standard. Okay. Okay, let's see. Okay, so you have seen, I have explained all the what I call as accounting principles. Very important, because you have to know the principles. Later you will use these rules and principles when you learn about recording process in topic 3. In topic 2, starting from topic 2. So let's see, we can test your understanding about these principles using these scenarios. Okay, there are several scenarios here. Identify the accounting principles that are related to these 5 scenarios. Okay, let's see scenario 1. Land worth 70,000 is reported at its original purchase price at $60,000. Okay, the thing is like this. A business has a piece of land. The value of the land now is 60,000. The purchase price of the land is $60,000. So the land worth 70,000 is reported at its original purchase price at 60,000. So this situation is related to which accounting principle? Okay, so the answer is related to historical cost accounting principle, because the historical cost principle says when you record an asset, you have to record it at the purchase price, not at the market price or market value or current value. Okay, that is one. Scenario B, including private costs incurred in running a car as business costs will violate the principle of what? Okay, remember? Okay, the situation is like this. If there is a business, and then including the private cost in running the car of the owner of the business. That will violate the principle of what? It will violate the principle of separate business entity. Okay, remember I have explained that in the previous lecture. In accounting, we have a principle called separate business entity. That principle says when you do the recording process, you record or you do accounting record for your business transaction only, not the personal transaction made by the owner of the business. In this scenario, running a car, private costs incurred in running a car, that transaction is a personal transaction of the owner of the business, not the transaction made by the business. So in accounting, you have to follow the separate business entity, and when you do the recording, you record the business transaction only. Okay, C. Bought goods from a supplier on
900.
a supplier on credit in December 2008. So this is year 2008. Let's say bought goods from a supplier on credit in December. We make it 2018. Bought goods from a supplier on credit in December 2018. Paid only in February 2019. Record the purchase in 2018 books. Okay, so this is related to which accounting principle? Okay, remember this. This is related to the principle of revenue recognition. This is related to the principle of revenue recognition. The revenue recognition principle says you in accounting, you record the revenue when it happened, not when you receive cash from the customer. Okay, so C related to revenue recognition principle. D, companies usually close their account and prepare financial statement quarterly. So this is related to which principle? Okay, it is related to time period principle. The time period principle says in accounting we assume that the life of a business can be divided into accounting periods. Okay, E, maintenance cost of a rental house are deducted from the rental revenue received each month. So this is related to which principle? The answer is this one is related to matching principle. Like I have explained earlier, in accounting, you have to follow matching principle. The principle says that if you want to calculate profit for one accounting period, you have to match revenue of that period and the expenses for that period only. Thank you very much. This is the end of the lecture. You can communicate with me in the comment section. Also, do not forget to write your metric number in the comment section so that I will take it as the attendance. And you can subscribe this YouTube channel so that you will you can see future videos that I will record for you. Thank you very much.